Good afternoon, everybody. My name is Tim Devlin. I'm one of the financial planners here at Life Pro Asset Management. And this week, we'll be bringing a special weekly update, really focused on financial planning. Now, next week, Robert Rayburn will be back for a weekly market and portfolio review video. But just this week, the S&P 500 entered into bear market territory. Now, a bear market is when the S&P 500 is greater than 20% off its highs. And over the past 8 months or so, we've experienced a lot of volatility. And so for investors, for our clients, for our families that are invested in these strategies, it's been a really painful time period in the markets. And so this week, I really wanted to focus in on just that and talk about really the planning side of things. And so the title of this week's presentation is We've Entered a Bear Market, Now What? And so to effectively navigate bear markets, first, we must understand the history of them. And then from there, we can gather some strategies to help navigate them. So the three things that I'll be talking about this week are: one, a review of bear market history within the S&P 500. Second, what are some action steps for those that are in the accumulation phase that they can do to navigate this? And finally, some strategies for those that are in the distribution phase. In other words, those that are in retirement are now pulling on those portfolios for their goals, their livelihoods, whatever they need that money for. And so first, let's focus on bear market history, because since 1950, there have been 16 bear markets. And so first, let's focus on the table on the left here. You can see the start date, the end date, the amount that the S&P 500 went down from its highs during that bear market, and the months that it took for that bear market to occur. Now, first, I'll focus your attention on the bottom of that table. You can see the average drawdown of a bear market for the S&P 500 is about 29.8%. And it took about 11 months for that to take course on average. Two, the second thing I'll point out is bear markets, based on this data set, occur roughly every 4 years on average. And so while the one that we're currently in, the one we've just entered, hasn't been the first in history, it likely won't be the last going forward either. But what's important to remember, and now focus your attention on this chart on the right here, is after all of these bear markets, there was an eventual recovery, and there was a birth given to a new bull market. And so you can see on the right here, this is the S&P 500 index level from 1950 through June 2022. And even with all of the chop that occurred in those painful time periods with those bear markets, markets historically have recovered. They've given birth to new bull markets. And so we want to focus on what we can do to navigate these time periods, to put ourselves in better positions going forward. And as investors, there's really two phases of our retirement journey. And the first one is the accumulation phase. So from the moment that you start working up until that retirement date, you're in that accumulation phase. You're trying to save money, put money in the market, trying to grow that nest egg that you have, and ultimately leads to a peak in your accumulated savings as you enter that date of retirement. Now, from that moment forward, you're starting to pull money out now that you've transitioned from getting a paycheck from your work to now funding your retirement. And so first, let's focus on that accumulation phase. What are some steps for those investors to take? And then second, we'll talk about that distribution phase. So first, for the accumulators, the big message here is to keep contributing. For those that have a long time horizon that are building up for that retirement, we want to make sure that we're still putting money to work. And it's not easy when we're in a bear market, because you can put money in and be down the next week. That's possible, right? But over the long term, we actually can see higher return potential from those dollars that you do put to work during bear markets. So I put together a chart here, a study, where it shows what would happen if you dollar cost averaged $500 a month into the S&P 500 total return index, and what that growth of that contribution would look like over time. And there's two big takeaways here. First, more time in the market leads to higher contribution values over time. In other words, the $500 that you put in September 1989 it's worth far more than the contribution you put in March of 2017, for example. Why? That money's had time to compound. So first, time is on your side when it comes to the market. Now, second, I've highlighted these bear markets, these bear market contributions. In other words, the $500 that you put in the market when the S&P 500 is greater than 20% off its highs. What you'll notice here is there's a very distinct uptrend with the green, where it goes back to that old adage: buy stocks low, sell them when they're high. It's not easy to do so, but you can see the proof is in the data. These green periods have a little spike here, and that's because you're buying stocks well off their highs. And ultimately, that'll lead to greater future return potential. And we actually did a second study to show just that. And what you'll see here is on this chart, first we looked at the drawdown of the S&P 500. In other words, how far off the highs are we? So categorized in 10% increments. So all-time highs to negative 9.99, negative 10 to 19, negative 20, that's that bear market territory, to negative 29.9, and so on and so forth. Now, today, we're in this range, in that bear market range. And throughout time, there's been 2,888 days where we've been in this type of scenario, in this type of drawdown range. And one of the things that's interesting when you look at the data is, based on these observations, the return that you'd receive 1 year forward is actually higher when you invest off the highs than when you're at the highs. So if you put money to work when the S&P 500 is right at its highs or within that 10% range, you'd average about 7.96% on the next year's return. But when you put money to work in those bear markets, similar to that chart we just showed, that return potential increases to 8.99%. Over 2 years, we're at 19.55, and over 3 years, 28.49. So the big message here is, and especially for those accumulators, if we're able to put more cash to work, we can actually give ourselves a better opportunity to receive higher future return potential. Now, this can go to the same for those in the distribution phase. If you have some extra cash that you don't need to spend, that you're able to put in the market, this is an opportunity for you as well. Ultimately, it will depend on your situation, and I would implore you to talk to your advisor and say, hey, if I do have a little extra cash, if I can add a little bit more in savings, how can we take advantage of this time period? So the big message for accumulators is to put more money to work if you can, stay disciplined, stay invested, allow that time to compound. Now, for those in distribution, it's a little bit different, because now you're withdrawing money. You're not putting money to work at the same, or rather, you're not saving money at the same rate that you were previously when you were working. So for those in distribution, the message and the big thing you should take away is to stay invested, because when we look at the data, staying invested is very, very important. And so what you can see here is the annualized performance of the S&P 500 Total Return Index between January 2002 and January 2022. And if you were to stay fully invested during this 20-year period, you would have averaged 9.4% per year. But if you missed the 10 best days during that time period, you would have only averaged 5.21%. Missed the best 20, you're down to 2.51% on an annualized basis. And if you miss 30 of those best days, you're down to 0.32%. Now, that's the first thing. It's important to stay invested so we don't miss those best days. But to build on that, 7 of the 10 best days during that time period occurred within 15 days of the 10 worst days. So a good example of this is, as we're reaching that bottoming process in the market, as we've had this drawdown, we've entered into a bear market, you tend to see more volatility. You tend to see very large down days, but you also tend to see very large up days as they're trying to create that bottom and ultimately a recovery. And so it's during those time periods that it's really important for us to stay invested, because if we miss those best time periods, it's a huge detriment to our long-term success as investors. And so for those in distribution, the biggest thing, the biggest takeaway is to stay invested. Now, second, what are some things that we can do to manage a bear market specifically? Obviously, staying invested is one thing. We want to do that, but we're not always able to. We have to fund our lifestyles. And so there's a couple different strategies we can talk about as it relates to withdrawal rates. And so there's really 4 things that can affect your withdrawal rate with your portfolio. First, your time horizon. If you have a long time horizon for retirement, if you're an early retiree, you have to plan for a much longer time horizon. And so your ability to draw on that portfolio, maybe you have to take less out per year than you would if you retired later, say if you retired at 70 and you had a shorter retirement. That'll have a big impact on withdrawal rate. Second, your portfolio asset allocation will have a large impact on your withdrawal rate, because if we have a more conservative portfolio, we would expect a lower potential return. And that means we can't withdraw as much. We don't have those investments compounding at the same rate. On the flip side, if we're being a little bit more aggressive, we have a little bit more risk in the short term when we do take those withdrawals. But over the long term, we may be able to increase that withdrawal rate, assuming good returns. Third, we have spending flexibility. In other words, how much you're able to take or how much you need to take. We'll talk about that in a little bit more in just a second with this example on the right. And then lastly, the degree of certainty desired. In other words, how secure do you want your retirement plan? If you want a higher degree of certainty, we take out less money. If we want to take out more money, we're going to have a lower certainty in that retirement plan. Now, as it relates to spending flexibility, I have a good example here of what's called dynamic withdrawals. And so this is one thing that you may be able to implement in your plan to say, hey, during strong years, maybe I can take a little bit more from my portfolio. In this example, $5,000. But during down years, I'm going to take a little bit less. I'm going to take $3,000. And the reason being, if I don't take as much out of my portfolio, when it does recover, I'll be able to participate in more of that recovery. If I'm selling more to fund, let's say you took out that $5,000 in a down market, well, you're taking away your ability for those dollars to participate in a recovery and ultimately compound over time. So over time, we get an average withdrawal of around $4,000, but this can help manage those bear market times and that uncertainty and the painful time period where your portfolio does go down. If we're able to, if we have the flexibility to take a little bit less during those years, when we do get a recovery and ultimately that bear market leads to a new bull market, maybe we can take a little bit more out during that bull market and take a family vacation or one of those other goals that you had in something like that. So that could be something where you implement in your plan. Now, as it relates to all 4 of these levers, again, talk to your advisor, see if you can implement any of these things, see if any changes can be made as it relates to the current scenario, and put yourself in a position to do well in that recovery process when we eventually do see one. Now, the bottom line here is bear markets are common occurrences, and that's not to say they're not hard times to navigate, because they are painful. Seeing your account values go down is hard. But if we have a good plan in place, we can do a better job of navigating them. So a couple key takeaways here. First, bear markets do occur on average once every 4 years, and they have an average duration of about 11 months. So that's first thing. Second, for those accumulating, we should think of this as an opportunity to buy stocks well off the recent highs with the potential to increase our future returns. Again, it goes back to that old adage, we want to buy stocks when they're low, we want to be a seller when they're high. For those in the accumulation phase, you are able to take advantage of this with your savings through work, with the extra cash that you have to buy more stocks when they're well off their highs. And then finally, for those in distribution phase, first, the data suggests that we need to remain invested. Missing those best days has a really big detrimental effect on your long-term return potential. But second, talk to your advisor about those different levers that you can use to manage the sequence of withdrawals within your portfolio. And maybe we can navigate this these times a little bit better, or put yourself in a better position once we do eventually see that recovery in the market. And so with that, I want to thank you for watching this week's episode, this week's update. And again, encourage you to reach out to your advisor if you have any questions. Talk to them, see if you can put any of these in place, and just discuss what's going on and how you can better position yourselves in the future. So with that, I want to thank you.